Hey everyone, it's Ben Hardy, and in today's video we've got some big updates for what everyone is calling the banking crisis. Before we get into this video though, as always, if you're going to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So let's start things off by talking about the banking crisis side of things, and then we're going to dive into car repossessions, and then we're going to pull everything together and talk about how this is affecting the car market in real time. So the banking crisis is still ongoing. I know that we live in a world where people just move from one topic to the next day by day, but this is something that's going to take a while to unfold, or at least that's what the experts are saying, because, well, I'm not an expert in this field, but from what I have read is it's going to probably take the next 6 to 12 to maybe even 18 months for this whole situation to unravel, for us to realize like how bad the banking situation is here in the US and abroad. I mean, the most recent like headline story was with Deutsche Bank. That's what everyone is currently talking about. Like, is this the next one that's going to fall? And I mean, that lending institution is massive. I mean, I think they have like over $1 trillion in assets. I mean, it's absolutely insane. But regardless, for today's video's sake, all you need to know is because of this ongoing banking crisis, this is causing credit to continue to tighten. So lending institutions are becoming a lot choosier with who they are giving out loans to, and the loans that they are giving out are becoming less and less appealing because they're like, okay, well, if we're going to give out this loan, it better be super beneficial because we don't want to be the next lending institution that is, under the scope of everyone, right? That's what all of these banks are now trying to avoid. And so until this whole, banking crisis figures itself out, we're just going to continue to see more and more credit tightening. It'll eventually reach the peak, but it doesn't look like we've reached the peak quite yet. Now, on the car repossession side of things, it's continuing to worsen. Now, I will say that we don't have a big data set quite yet in terms of what's happened initially here in 2023, but the last data set that we had from the end of 2022 showed that the repossession rate was ticking up over 6%, and I'm sure that it's only increased since then because, well, interest rates have increased, and so anyone that's in a position where they are struggling to make their payment, they don't really have a lot of options to get out of that bad situation, and so they're going to have to choose between either, somehow pulling together money to make that car payment or just not making their car payment and then eventually having it repossessed. And something that I feel like is really telling with this situation is I've noticed that there's a lot more videos on YouTube and on other social media platforms of people that basically make a living off of repossessing cars, right? They're the tow truck drivers, and it seems like it's just exploding right now. Now, obviously, that doesn't mean that the situation is exploding, but at the same time, it's like, why are we all of a sudden seeing more and more content with this? And then like I've seen some stuff like how to become a repossession driver, so or like a repo tow truck driver. So it looks like the situation is continuing to worsen, which is obviously going to go back and impact the lending institutions, because if we have more and more repos, that means that these lending institutions are going to obviously have to absorb those costs, and so this is going to cause credit to tighten even further. And so now let's talk about how this is actually affecting the car market in real time. So first off, with car repossessions, you would think that with the increase in repos, that this would put downward pressure on the used car market, right? This would basically be an influx of used cars and used cars that are frankly not in the best condition, which would just naturally bring down values. If you don't know, the values on a car are determined by what that car looks like on average. And so if you have, let's say the Toyota Camry, for example, if you have a bunch of repossessed Camrys that flood the market that are all in horrible condition, that'll bring down the overall value of used Camrys because the average example is not in great condition. And so logically, used car prices should start to come down, and we all know that's not what's happening. Used car prices are continuing to increase on the wholesale front, and the retail values are starting to creep up as well. Again, retail values always lag behind wholesale values, and this is where I'm going to dive into my tinfoil hat conspiracy as to why I think this is happening this way. So outside of everything that's happening within the market that's pushing used car prices up with, like low availability and all that kind of stuff, I am going to go out and say that I think that lending institutions are purposefully not selling all of the repossessed cars at auction that they could sell. I do know that there are definitely repos that are being sold at auction or attempting to be sold at auction. However, again, with my little conspiracy, I think that the banks are just holding on to these cars and waiting because, again, used car values, although are increasing in the short term, have declined quite a bit from the peak. And so I think that these lending institutions are basically holding on to these cars so that they don't have to realize the losses on these cars. Again, you've got lending institutions that are currently holding on to a bunch of bonds that they don't want to sell because they would have to realize a bunch of losses on those. And so I think the same thing applies to these cars where they're holding on to them and they're just kind of waiting things out so that they don't realize the losses, so that it doesn't make their stock price go down or whatever. Again, I don't have any proof for it, but that's just my little conspiracy on that side of things. And this leads us right back into the auto loan side of things. So you probably noticed several times throughout this video, I mentioned credit tightening, and this is very important for what is currently happening within the market. What dealers are telling me that they're currently experiencing is a situation where it's either extremely difficult to get someone approved on a loan, or if they do get an approval, they're just coming back and they're really crappy approvals. And what dealers are saying is if they had that same customer with that same credit situation, trade-in situation, down payment situation, everything, come in and buy a car, had come in and bought a car, 2 or 3 months ago, it would have been a complete breeze. They would have gotten an interest rate that would have made sense for the customer to give them a payment that made sense, and frankly, enough approvals to be able to get the deal bought where, again, it made the most sense. And that's just not what's happening. More and more of these lending institutions are just flat out denying these loans. And if they're not denying them, they're basically just saying, yeah, here's the deal. We will give you a loan, but we're going to make sure the interest rate is astronomically high, so you're paying a ton of interest, and so your payment is super high because we want to make sure that we make as much money off of this loan as possible if we're actually going to go out and give the loan. And the thing that's crazy about this situation is, yes, interest rates have increased a bit over the last few months, but not by an insane amount. I mean, for a lot of buyers, you might have been able to get like a 0.5% or maybe a full percent less just a few months ago, again, depending on credit, depending on the whole situation, whereas now it's just a little bit more. But well, technically should be a little bit more, but in reality what's happening is it's a lot a bit more. Like I said, the lending institutions are just giving out crazy rates, and so it's naturally going to be pushing a lot of people out of the car market. With that being said, the thing that is probably the most shocking to me is the fact that lending institutions are still willing to give out loans to people that have horrible credit. I've had several dealers that kind of specialize with, customers that don't have the best credit tell me that not only are they still able to get those customers approved, but they're able to get them approved with interest rates that aren't frankly all that crazy for that group of people. So let me give you an example. One dealer told me that they had a customer come in that had, roughly average credit, and they wanted to buy a used car. They got quoted 16 to 18% in terms of their APR on that pre-owned vehicle. And it wasn't like a super high mileage vehicle. It's under 100,000 miles, and it was relatively new. And again, this person had about average credit. Now they had another customer come in that same day that had horrible credit. Like they had repossessions. Basically, that person should probably file bankruptcy. Like their credit was just trash. They did get an approval from a lending institution, and the APR was in the 20% range. So like it was definitely higher than the person that had average credit, but it wasn't like twice as high or something like that. Obviously there are caps, like lending institutions can only charge so much interest. But the point that I'm trying to make here is we're in a market where if you have like perfect credit, then you won't get the best interest rate, but you can get okay interest rate. If you have average credit, you're going to get a horrible interest rate, compared to what you could have gotten, last year or the year before. And then if you have absolutely horrible credit, the interest rate you're getting today is actually not all that different for the most part compared to the interest rate you would have gotten a year ago, because a year ago, these people with horrible credit were still paying 20+% APR. And so it's interesting what this is doing with the market dynamics, because basically people that have perfect credit, they're able to buy. People that have horrible credit, they're able to buy. And then people that have average credit, they're not able to buy. They're pushed out of the market based on affordability. Pulling this all together with the banking crisis situation, like I said earlier in the video, it's just too soon to tell exactly how far this is going to go. But I feel like it's safe to assume that this is just going to push for more and more credit tightening. So lending institutions are going to basically become stricter and stricter with who they're willing to lend to, which I find crazy because there's so many of these deals happening with people that have horrible credit. So it's, again, I don't understand it, but I'm just reporting the facts to you guys. That's just ultimately what is happening. So just expect more credit tightening as the year progresses. And then when it comes to the repossession situation, again, too soon to tell, but like something's got to give. Like the amount of repoed cars that are being sold at auction, it just doesn't account for the repossession rate that we currently have. It's like, where are these cars? Why are these cars not getting sold? And when they get sold, you know, we'll see what happens. But like I said, if you have a bunch of cars that have bad condition that flood the market, right, that is going to bring down prices, because the average car in that segment, right, is now going to be worse condition after the cars flooded the market. So this could finally, you know, alleviate the prices on these used cars. We'll see. Again, too soon to tell. And then, you know, finally, with the whole credit tightening situation, it really is splitting up the market. And so we're going to continue to see this trend where really expensive Highline cars are still going to be selling. They're still going to be selling for price premiums, because people that have great credit and people that have money, they're still able to spend. And then those more affordable cars, those are going to get bought up by the people that have really bad credit, or, you know, frankly, people that have average credit that have enough money to pay for those cars in cash, because they can't buy the more expensive cars because interest rates for the average person right now are just absolute trash. Like it's a market that doesn't make sense unless you're super rich, or unless you are really bad with your credit and you've absolutely destroyed it. So let me know what you guys think about this whole situation. I'll see you.